What's going on, everybody, and welcome on into the channel. So today we are talking options for beginners. We're going to be going through a complete guide on what you need to know when it comes to trading options. We're going to be talking everything from the absolute basics to where to trade. We'll do some examples live trading, and then we'll also talk about the Greeks. We'll dive a little bit deeper because not many people want to dive into the Greeks, but I figured now in this video, number one, my audience has become more advanced. Number two, I want to make a thorough video for those who may be new here to get a full big picture view, how to trade options and what a lot of this stuff you'll be looking at means, okay? Because at the end of the day, you don't really need to know the Greeks, but I wanted to make sure we included that and dive deeper here in this video, so we're going to make sure to talk about that. All right, guys, so here we go. Let's just go through a slideshow. I will leave a link to this slideshow in the description box down below. Take advantage of that for free. There'll be some links in the slideshow. If you want to refer to those links, you can use that, and it's super easy to do. If not, you can also kind of just follow along. But we're going to use this as a base, and then we'll dive into the platforms. We'll dive into some other examples or some other definitions, sites, and whatnot that we can dive deeper into. So what I want to do here in this video is we want to cover a lot of things. We'll dive into the basics as what options are, why people trade them, the types of options you can trade, where to even go buy options these days, because there's a lot of options, right, when it comes to your platform of choice and what brokerage platforms offer different styles of options trading, which ones offer different perks to other ones. We'll talk about the Greeks, of course, we want to dive into that. We'll talk about different option strategies. There's a lot of strategies out there. We'll talk about some of those. We'll do a live example, we'll talk about the risk, and then, of course, some next steps. Now, before we dive into the meat of this video, all we ask is a thumbs up if you get something out of the video. If you don't, that's okay. Let us know in the comments down below what you would like to see in the future, but that is all we ask. We're not going to try to sell you anything here. We don't have an options trading course that we're going to sell you on the back end because that's kind of how a lot of this stuff tends to work, right? I want to cover a lot of that here. So here we go. What are options? Let's dive into a formal definition so you guys can kind of see this stuff live. But a stock option gives an investor the right, but not the obligation to buy or sell a stock at agreed upon price and date, okay? So that's all it really is, okay? You're getting the right, but not the obligation to buy or sell 100 shares of a stock at a specified price by a specified date. That is pretty much it. If we dive back over here, we can see that there are calls and there are puts. And for many traders, that's really all they know. They know calls, they know puts. I'm going to go buy calls of a stock if I think a stock's going to go up. I'm going to buy puts if I think a stock is going to go down. Now, we'll dive deeper into that and what those mean, different strategies. But for the most part, that's what it is. You'll see calls and puts, okay? Now, options are traded as contracts, so they're not like shares, right? I can go ahead and I can go buy a share. Nowadays, I can actually go ahead and buy fractional shares from different brokerage platforms, which is pretty cool. So it really kind of cuts the barrier to entry for pretty much anyone who wants to get started investing with almost any amount of money. Now, one contract is the right to buy or sell 100 shares at the strike price by the expiration date. Now, we'll dive into the strike price and the expiration here next, but that's what you have to understand when it comes to options. So we trade option contracts. We're not trading shares, okay? Now, the contracts give you the right to buy shares, and so based on kind of the behind the scenes, these contracts will have a value. And these values are determined in a bunch of different ways, which we'll cover. And really, you have to just know that premium that we pay for an option contract, okay, essentially what's going to cost us to buy or sell one, right? That is what we're trading, okay? When people trade options, many times they're not in it for the underlying stock. They don't want to buy the 100 shares. They don't want to actually sell the shares. They don't care about that. They want to buy the option contract at a price and they want to sell it at a higher price, right? Or you can play different types of strategies where different types of things come into play, but pretty much at the core of it, that's what it is, okay? And depending upon which way you think a stock's going to go, you'll buy a certain contract, and if it goes your way, you'll sell it for more. That's really it. And you can make a lot of money doing that because when it comes to options, you have something called leverage. Now, we'll cover that in a second, but the strike price here, I want to cover this. It essentially is what you use to identify an option contract, and we'll show you a full kind of list, and we'll show you a full walkthrough of identifying a bunch of strikes and all that stuff in just 1 second when we dive into the example. But if people talk about an option, they may say, I'm going to buy the $100 calls on this stock. I'm going to buy the 100 puts, or this or that. And that's kind of what they use to kind of classify or name their option. So it identifies the option, right? Now, the strike price also helps determine where the contract's value will end up being by a certain date, right now, next week, next month, all of that stuff. And you'll see the terms in the money, ITM, or out of the money, OTM. that's essentially based on the strike price. So depending upon where the stock is trading based on the strike price, it may fall in the money or out of the money at the current time. Now the expiration date. This is the date that the option contract expires. So either the option contract is in the money and it's executed on the expiration date based on whoever's holding it, or the option expires worthless. And that means it would expire out of the money. The option has no value. So that's one of the biggest things we need to understand when it comes to trading options, okay? We could buy an option contract that could go to zero, and many times they do go to zero, and we could be holding an option contract that is worthless. So we need to understand that going in. Now it helps with your risk reward because you know if you're just going to buy a call, you know whatever you pay for that call is your worst case scenario loss. So if I pay $500 for a call out of my pocket, out of my account, I know that worst case scenario, if this expires worthless, I'm going to lose $500, right? Now, when it comes to stocks, are you going to see a stock go to zero? Probably not. Or would there be an opportunity or many opportunities to sell a stock before it becomes worthless? Probably. So it's a little bit more risky. It's a little different. But at the end of the day, your puts or your calls, they could go to zero. They could expire worthless. And that could be a good thing or a bad thing depending upon the option trading strategy that you're utilizing. All right, so in the money versus out of the money. So ITM, that means for a call, okay, the stock price, the current stock is trading at is higher than the strike price you're looking at. For a put to be in the money, the stock price is below the strike price, okay? Now, out of the money, it's the reverse side. So for calls, a call is out of the money if the stock price is below the strike price, and a put is out of the money if a stock price is above the strike price. Now, I want to pull this up really quick. So this is Weeble's platform. We'll dive deeper into this example in a second, but on the left-hand side, what we're looking at is on the left, we're looking at calls, and on the right, we're looking at puts. It's identified here on the top right here. And so here are the strikes going down the middle of our page. Here's the current stock price across the middle of the page, or the middle of the option chain, as they call it. And we can see that this back shading is like a slight blue tint or a turquoise tint or something along those lines. That's because these calls or these option contracts are in the money, and out of the money is the darker shading. And so for puts on the bottom right, these contracts are in the money. Okay, so Webull kind of classifies it that way. It makes it easy to visualize if you're looking at the option chain this way. Okay, so now for the option price, we have intrinsic value, which really is how much a stock is in the money. What's its intrinsic value? That's what it means. The extrinsic value is essentially going to be the other factors at play. So you may look at a stock that's out of the money and it still has a price. There's still a value there. Why? It's because of extrinsic value, okay? That's the difference between the option price and the intrinsic value, but also the other factors like time, volatility, and other variables come into play. So you may have an out-of-the-money contract. They're generally cheaper, but other factors like how volatile the stock is, how much time until the expiration date of that option, that's going to factor into how much you're going to have to pay to buy that contract that may currently be out of the money. Now, another key point that we also want to make, what is it going to cost you to buy an option, okay? Your out of pocket, your out of account cost, what you're going to pay to open a long call or a long put. Now, we say long call, long put, but what that means is that we're buying a call or buying a put. That's simply it. When you're buying a call, you're bullish if that's all you're doing. If you're buying a put, you're bearish if that's all you're doing. You're going to take the option premium, the cost of the option, what it's going to tell you. Let's say it costs $1, okay? You're going to times that by the number of contracts you want to buy. Okay, if I want to buy one contract, $1 times 1, and then multiply that by 100, that's how much it's going to cost you out of pocket. So if you see an option that is trading at $1 per contract, know in the back of your head that that's actually going to cost you $100 out of your account to buy this contract. Now you may ask, why do we trade options? Well, that's because of something like we said before, that's leverage, right? When we trade options, we have leverage. We can use less money to make more money, right? So we get the leverage essentially like owning a ton of shares of a stock, but we don't have to pay out of pocket what it would cost to own that many shares. So let's say I want to get 100 shares of Apple and I want to trade Apple for, let's say, a $1 move. Well, if I have 100 shares of Apple and Apple moves $1, I'm going to make $100. That's cool, but how much is that going to cost me out of pocket? It's going to cost me a lot of money. Based on Apple's price right now, that's going to cost me thousands of dollars. Do I really want to spend $1,000? Do I want to tie up $1,000? Or do I even have thousands of dollars if I'm someone who's starting out with a smaller account to jump in and trade? Probably not. You're also able to utilize options to make money a lot of different ways instead of just playing directional bets. So one of the most common ways is a directional bet. Means, okay, I'm going to buy a call, I think the stock's going to go up. I'm going to buy a put, I think the stock's going to go down. Straightforward, right? But there's also things like spreads, and there's different other types of option strategies, which we'll cover some of them here in this video. And those different strategies allow you to make money if a stock maybe just sits still or kind of trades between a certain range. And that allows you to kind of take advantage of other opportunities where maybe you think this stock is not going to move. And instead of not trading it, well, you can trade an option on it and boom, you can make money if a stock just sits still. That's a way to take advantage of the time decay, which we're going to cover here in just a second. So types of options: calls, upward directional bet; puts, downward directional bet. That does not mean if a stock goes up and you have a call, you're necessarily going to make money. If it goes up in a short period of time, most likely yes. But like we said, because of extrinsic factors and because if the stock's in the money or out of the money, depending upon where it is, you may not make money. If let's say you pay $1 for a contract and that contract is currently out of the money, it has no intrinsic value. Well, if it expired or it finished right where that stock finished right where it's at and that contract ended up out of the money by the expiration date, it's going to expire worthless. So even though the stock may kind of climb a little bit or maybe it sits still, you could still lose. You have to understand that, okay? Same thing with the puts. Now, there are two different types of spreads. There's credit spreads and then there's debit spreads. These two videos, so with that link down below in the description box for this slideshow, you can click on these videos. These are two videos I made on the TC Trading channel. I'll talk more about that at the end of the video, where we dive into debit spreads and credit spreads, full tutorials using the Webull platform. So credit means you're going to get paid to open the contract. Debit means you have to pay out of pocket to open the contract or open up the option position, okay? That's what it means, okay? Now, with a credit spread, you get paid, but to close it out, you may have to buy it back. And if you buy it back, you could end up buying it back for more than you got paid, or ideally less than you got paid, and you keep the difference. All right, so now for the Greeks. I have a full playlist right here that will cover the 3 most important Greeks, in my opinion, that most people need to know before they open an options position, but there's actually 5 we're going to talk about here in this video, okay? Delta, gamma, and theta, okay? Delta, gamma, theta, those are covered in those videos, and those videos are 10 minutes or less. Within about 20-25 minutes, you'll have a good understanding of all that stuff if you want to check it out. That link is on the TC Trading channel. It's the Option Greeks playlist. It's also linked here in the slideshow as well. So those 3 Greeks we'll cover first. Delta. Let's understand what delta is. Delta measures the degree to which an option is exposed to shifts in the price of the underlying stock or commodity. They range from 1 to -1, depending upon calls, puts, and whatnot. So what this means is depending upon the delta, what that will tell you is if a stock moves $1, how much is this option going to move? The option's worth $1, right? And we get a $1 move in the stock. What is that going to mean for my option? Well, delta is going to tell you exactly what that's going to mean for your option. So you can back your way into, okay, if I have a price target of this, here's roughly how much this option is going to move if this price target hits on the stock. Okay, that means this option is going to go up this much in value. Back my way into it, and just like that, I'm good to go, and I have a great understanding as to the pricing of the option. Next, I want to talk about gamma, but using this chart right here, it'll make it a little bit easier. And of course, the links are always here, so you guys can refer to these links of this slideshow and dive deeper if you would like to. Gamma is going to measure the rate of change of the delta. That might sound complicated, but the delta is not going to be the same. The further a stock gets to being in the money, the more the delta is going to move towards 1 or -1. So you can be looking at options that are almost trading exactly along with the stock. If you have a very deep in the money option contract, there's a good chance that every $1 move in the stock means $1 more intrinsic value. If the stock's already deep in the money, well, that option contract is probably going to move roughly $1. Okay, so you guys can kind of see what I mean by being 1 or -1 and what the gamma means. So that's what the gamma is helping you understand when it comes down to it. Not a huge thing, but once you understand delta and you're looking to back your way into a move, understanding gamma is definitely helpful. Now we have theta, okay? So theta is really interesting. Theta is the time decay. It measures the impact of a change in time remaining. So what you'll notice is that if you have an option that expires relatively soon and it's out of the money, well, that option is going to start dropping in value very quick unless that stock starts moving in the direction that you need it to move. Okay, that's theta, that's time decay. Okay, so impact of the change in time is absolutely critical. Now, theta is usually a negative number, and as a negative, it indicates how much the option's value will decline every day up to the maturity or the expiration date. Okay, that's what that means. Okay, so let's dive a little bit deeper here. Let's go to Vega and then we'll go to Rho. Vega measures the impact in a change in the volatility. Okay, so it starts to kind of get confusing here. So I do want to pull this up as well. This change in volatility, so Vega represents the amount an options contract price changes in reaction to a 1% change in the implied volatility of the underlying asset. Long options have a positive Vega, while short options have a negative Vega. And then last but not least, I do want to pull up Rho. Rho is the rate at which the price of the derivative, the option, changes relative to a change in the risk-free rate of interest. So something that a lot of people don't really worry about too much, but essentially it measures the sensitivity of the options on an interest rate change. Probably the least important, I would imagine, for basic options traders, but it's something to also note. Again, these will all be links. You can find more information there. That full playlist going over delta, gamma, theta with live examples, talking about the numbers and what they mean. We cover that as well in those videos. Now let's get into some option strategies. I don't want to go too deep because we can really take a lot of time on this stuff. So again, that video or that channel, TC Trading, is going to have a full kind of list, and we pretty much covered every single one of these strategies on that channel's option playlist. So check it out. But most people buy calls and puts depending upon a directional bet. So that means, okay, I think Apple's going to go up, I'm going to buy a call. I think Apple's going to go down, I'm going to buy a put. Cool, great. But there's a ton of strategies. We talked about credit spreads, debit spreads. Those videos are linked back there. There's things like a straddle. Let's talk about a straddle really quick in basic terms. It's a neutral strategy that makes you buy a put and a call for the same stock with the same strike price and expiration date. You'll profit from this if the stock is super crazy in terms of a move up or down. So the stock could go crazy high or crazy low. If it ends up expiring in between, that's where you end up losing here. But if you're expecting a big move in a stock and you're not sure which way, a straddle is a great way to go, because if it goes crazy high, you'll make money. If it goes crazy low, you're also going to make money. Now, there's something called a strangle. It's a similar situation, but you're holding positions in a call and a put with different strike prices, and they're going to have the exact same expiration date. This is if you think a stock is going to see a big, large movement, you can play a strangle as well. There's something called the butterfly spread. This combines both bull and bear spreads, and it has a fixed risk, but also a capped profit. So you know exactly how much you're risking. You know exactly how much you could make best case scenario. This is also a neutral strategy, and they pay off the most if the stock does not move prior to the expiration of the option. So if you think a stock's going to sit still and not make a big move, boom, you could play a butterfly spread and be set and ready to go for taking advantage of not much movement. There's also condors, there's even iron condors, and a condor spread, there's actually two ways to play it. You can play it where you'll make a ton of money if a stock makes a big move up or down, or you'll make money if a stock sits still. It's similar to kind of a butterfly spread in a sense in that regard. And then there's also a calendar spread. A calendar spread is an options or futures strategy established by simultaneously entering a long and a short on the same asset but with different dates. So the calendar spread will help minimize the time effect, but it's going to make it most profitable when the asset, the stock, does not make any significant moves in either direction until after the near term option expires. It's another way to play things. It's a more advanced strategy, but again, it's worth noting. So now I want to dive into where could we trade options? There's a lot of places to go these days. There's Webull, TD Ameritrade, Robinhood. The reason why I have those three listed first is because I believe these are the easiest places to trade options. Now, there are fees on TD Ameritrade. There are no fees or very minimal fees in terms of commissions on Webull and Robinhood, okay? A lot of people do not like Robinhood, but it's very simple, okay? Now, I would definitely caution yourself if you're going to use Robinhood as your only platform, because I think that there's a lot of value in looking at a lot of data, looking at charts, seeing the Greeks, seeing all this stuff, and it may be difficult to see on a Robinhood platform unless you're on like the web version or something like that. So I personally would recommend Webull for options trading for most beginners. Now, if you're also concerned about the PDT rule, which is the pattern day trade rule, which means under $25,000 in a margin account, you can't make more than 3 day trades in a span of 5 trading days. So for those who are concerned about that, you can go to a Webull cash account or use a cash account with TD Ameritrade as well. If you have a cash account, what you're able to do is you're able to have options settle 1 business day after the trading date. And what that means is it essentially gets your money back faster, because when you're using a cash account, you want to be able to utilize settled cash to trade. And there's no PDT rule. You can trade as many times as you want. You just can't run out of settled cash. And when your options settle in 1 business day after the trade date, it's super nice because it makes it easy to kind of refresh your portfolio in terms of, okay, now I have more settled cash. I can go and make more trades the next day and the next day, as long as you're not going with your entire portfolio, your entire account in one position. If you spread your money out, utilizing options to use leverage to make more on a trade, well, then you can certainly make, 5, 10 day trades in a week, depending upon how large your position size is, if you're using a Webull cash account or really a cash account on any platform. Now, there's plenty more out there in terms of, let's say, like an E-Trade. You want to go to Trade Zero, you want to use Interactive Brokers. There's plenty more platforms where that came from. But for most people, the Webull, TD Ameritrade's, Robinhood's are most accessible. They're the cheapest to use and they're the easiest to use. We're going to use Webull in this example. So if you want to follow along and do the exact same thing, you can actually sign up for Webull below and get some free stocks. I think right now when I'm filming this video, they're giving out 5 free stocks. That may change. That link is in the pinned comment and description box down below. To sign up, get 5 free stocks, plus I think $5 in free crypto as well. All right, so let's dive on into Webull right now. I'm going to let's go utilize like a bigger name stock. Let's go utilize Apple for an example here, okay? So there are plenty of videos on my channel right now, also on the TC Trading channel, okay? If you guys want to learn how to set up a customized Webull layout, you want to do all this good stuff, anything you want to do, links in the description box to the TC Trading channel or on my channel. Look up Webull in the search bar of this channel or go to the Webull playlist on the other channel, and you should find plenty where that came from. Okay, let's say I think Apple, actually, here's a perfect example, right? Apple had a high this morning, pre-market hours, of up here towards about 172.50. We're at 172. We're actually getting rejected right now at that level. So what I'm going to do is I'm going to buy a put on Apple. I think Apple is going to go down. So I pull up the option chain. It's the option trading widget. I'm going to zoom in as much as I can so you guys can see this. And what I'm going to do is right now I have both calls and puts selected. I'm actually going to go to just puts so we can kind of see this super easy. So now I have it set to just puts. And right now it is December 21st when I'm filming this video. These expire in 2 days, December 23rd. So what I'm going to do is I'm looking at Apple right now. It's at 172.09. I'm going to target the 170s. They're about $1 right now. They're out of the money, okay? So I have the risk of this expiring worthless if Apple doesn't go below 170 by the expiration date, but I'm going to buy these, okay? I'm going to buy them and sell them and show you guys the example first, and then we'll kind of back our way through understanding what just happened, okay? So when I click on the option that I want, it's going to open up the order entry widget, which is this guy right here. It will then allow you to confirm. Single option, yes. Apple is the ticker symbol, yes. Strike price, yes, I want 170s. Here's when it expires. I can change all of these things, guys, right here as well, okay? I'm buying a put, and I want to buy just one put in this case. Now, I go back to the option chain. I see that they're trading between $1 and $1.01. If I want to get filled right away, I'm going to go to 101. I'm going to buy that right there. Limit order 101. Click on buy. Boom, I was filled. Boom, we're good to go. Now, if I want to go back here and I wanted to buy this, I could use a market order and they'll fill me in between the bid and the ask. I don't have to use limit order, but if I want to get a specific price, I'll use a limit order there, and there should be a video either on this channel or the other channels that will dive deeper into understanding the difference in the order types on Webull, but a market order will fill me right away. So back to my chart. What do we got? We have a 170 put sitting right here, okay? Now, we're in this position. If I go to my left-hand side, my position list, I got a lot of positions right now. I will find now Apple. You can look at the chart of the options. Take a look at this. This option this morning was worth $4.62. So you guys can see now the power of options. So from that move, this is now down over 80% today because Apple has moved up and we're buying puts. So I will sometimes utilize this chart as well to kind of look at Apple and say to myself, okay, I think I'm going to sell this now for a profit or whatever I'm going to do. So now over here on my classic trade widget, I can come into this. It's now the Apple puts that I was looking at or that I now have selected as my chart, and I can go over to sell, and I'm going to sell one. I'm going to sell this for 103 because I made a few cents. If in the process, I'm going to click on 103, sell, make sure I confirm that. And now you'll see that sell has popped up on my chart. This is the chart for the option contract that I was looking at. Now, right now, the bid and the ask is up in the order book section. We have 101 by 102. If it pops up a touch more, I should get filled if Apple starts to push down. That means Apple goes down, the puts go up, boom, there we go. We just got filled. We just made some money. There you guys have it. That's basically quickly live how this stuff works, okay? So I made a few bucks. Now they're going back down, and you guys can see. Take a deep breath. Let's unpack what just happened. Okay, back to the option chain. Here we go. If I wanted to look at this a different way, I can double click or right click on the option contract, or I click on control click and go to buy. It'll open up the order entry. If you guys notice something that I use this order entry, I don't like to use this order entry personally. If I'm getting in quick, I will, but I like to use the graph feature for the bigger picture view if I'm backing my way into a trade or trying to understand what's going on. So what do I mean by that? Take a look at this, guys. Right now, we are looking at a graph. This graph is going to be very crucial in my understanding of how options work if I'm a beginner. So if you are a beginner, this graph is beautiful, okay? Everything is up here. The option, you can even place the order with this window, all that's there. But now what I have is I have this strike price selected, this specific put selected. And if I go to the number of contracts that I want, which is 1 in this case, if I go ahead and select that 1, now what's going to happen here is this graph is going to tell me where Apple's going to go by the expiration date and how much money I'll have made or lost. Okay, so if Apple actually ends up expiring at 170 or more, what ends up happening, guys, is I'm going to lose all that I paid for this option contract. But if Apple actually expires less, it tells me I'm going to lose less money. If Apple ends up closing under 169 by the expiration date, that's going to tell me that this option contract will have intrinsic value and how much money I could make. Now, I want to close this out before the expiration date, ideally, right? But this is very, very useful to understand intrinsic value, where a stock needs to go for me to make a certain amount of money. That is why I love, absolutely love, the graph feature here on Webull. And like I said, everything is here. I can change my strike price if I would like to. I can change my expiration date. I can change it from a limit order to a market order, whatever I want to do. I go to number of contracts. I can do all of that stuff, guys, here in this window, just like that. And if I want to kind of change prices, I can zoom myself out. I can go back to the left. I can zoom across how much I could lose. I can change different option styles. So if I don't want to use a single option, I want to go to do a butterfly strategy, boom, it's going to show me the butterfly strategy as well. Here it is. Now, I have more in-depth videos over on the TC Trading channel showing you guys all these different strategies, how it works and stuff, but that's what you have access to when you use the order entry widget with the graph feature in the bottom left. Now to understand our risk, okay? We need to understand our risk reward. We have to know when we are buying a put or buying a call, okay? What's happening here, guys? We are risking, okay? We are risking what we pay, okay? If that is all we're doing. There's other strategies. You can risk more, you can risk less. We are risking what we pay. So in that live example, I paid about $1.01 for the option. Well, I sold it for 103. But multiply those by 100. I actually spent $100, $101, and I sold it for 103. So I made $2, okay? On that, that's what you need to understand. And if you're targeting a certain price target up or down on a stock, back your way into that by utilizing the Greeks, utilizing intrinsic value, in the money versus out of the money. If a stock is in the money by $5 by this price point, well, guess what? That contract is going to be worth at least $5, then add in the extrinsic value, and it could be worth more depending upon how volatile, how much time is left till the expiration. As long as you understand that, you can do very, very well with options. But the biggest thing that I see people do is they will trade options on a very short time scale. So the one that I just did expired 2 days from when I did it, right? Obviously, it worked out for a second because it was a super quick trade and, it was only a 2-cent move, right? Whatever. But if I was to do that, right, consistently, and I was doing that across the board with a lot of stocks, and I was kind of just saying, yeah, I think it's going to go down, I think it's going to go up. Well, maybe I'm right next week, 2 weeks from now, but maybe I'm wrong in the short term. You have to understand that. And if you're wrong in the short term, you could blow a ton of money very, very fast. So make sure you understand that. Now, understand your risk tolerance. For me, I like to trade stocks with a certain position size. When I trade options, it's like a tenth of that position size because the option can move so fast, so quick, depending upon the contracts I'm trading. Obviously, if I'm trading longer dated contracts that aren't going to be as volatile, then I'll up my size. But you have to understand that going into it, right? Now, when it comes to using stop losses, right, you could technically utilize a stop loss on options, and there's a video on the TC Trading channel that dives into how to set stop losses on options plays, on options contracts, or trade options with a stop. The problem is on very volatile options that have a big spread between the bid and the ask trying to get in, it can be very easy to hit your stop loss and then the stock reverses and goes the other way, which was the original direction that you were anticipating, okay? Understand that going in as well. So personally, I don't like to use hard stops. I like to utilize a stop loss as a price point on the chart. So let's say Apple was the stock that I was looking at, right? And we were just looking at Apple. Let's go back to it really quick. We'll go to the chart. I was talking about AAPL. And I was talking about, hey, like this 172.50 level was our pre-market resistance. If we go above that level in the stock, that's when I will sell my option no matter what the price of the option is. You can also utilize, okay, if my option that I paid $1 for now all of a sudden goes to, 60 cents, I'm going to cut it there, or 70 cents or 80 cents, I'm going to cut it there. You can do it that way as well. Personally, though, I like to make the stock price dictate when I get stopped out, not the option volatility. And this is also very important to understand as well. So if you're down a certain percentage, then this is the gain that you're going to need to actually see on the option contract, or anything really in general, your portfolio, your stock, whatever, to recover to a break even. So if you're down 40%, you're going to need a 6-7% move to get back to break even. So you have to understand that this could go downhill very fast, and then all of a sudden you're in a hole and you got to dig your way out of it, and it may not happen by the certain expiration date, so you need to make sure you're at least aware of that. So there you guys have it. You're ready to go when it comes to your option trading right now. You can get started and start trying things out yourself. If you have any questions, you guys know where to find me in the comments down below. Also, there's a lot of other places you can go as well. I have plenty of videos. I 100% love to answer questions in the comments, but sometimes I miss them. Sometimes I get a lot. I'm busy or this or that, or I don't see them because YouTube sometimes these days just deletes comments because they think it's spam. And they leave the actual scammers in the comments somehow. I don't know. But there are probably a ton of places to go already in terms of past videos. So you guys have the access to my channel, which is linked right here, which you're watching right now, obviously. So you can go ahead and check out playlists there, tons of videos, all that stuff. You can go over to the TC Trading channel. I made this channel literally just for this reason, for tutorials. I don't care how many views these videos get. I literally don't care. These are all tutorial-based videos, okay? Showing you how to buy options or how to do this or how to do that. All these playlists are very, very helpful on the TC Trading channel. And then also, I have videos on the Stock Trends channel. The Stock Trends channel, we talk about some of the current trending stocks, what's going on, technical analysis, okay? That's our key there. So it's not really options-based, but it's giving a good sense as to what the market's doing, what stocks are doing, all that stuff. That's where I post. Also have other links and resources to a technical analysis trading course if you want to learn how to utilize technical analysis to help predict stock movements and to build your way into trades and all that good stuff. I collaborated with Joseph Hogue from Let's Talk Money, who has a massive channel, by the way, and a great channel as well. And he talks about a lot of stuff when it comes to trading, investing, stocks, all that good stuff. He has a great channel as a great resource to go to. But we also made that technical analysis course that's linked down below. Again, we're not trying to push that super hard on you guys, but it's a resource there for a reason. Twitter, you can go there and find me, and also my Instagram. There are tons of scammers. I don't post, at least as of now, too much on Instagram. So if someone starts messaging you, it's probably not me. 99% chance it's not me if I'm messaging you, right? So that's places to go. Hopefully that was helpful. Again, you can get those 5 free stocks plus $5 in free crypto with Webull, link down below. That's a platform that we just used, which is right here to trade those options. And as we speak, Apple is getting very, very close to breaking over those highs. So there you guys have it. Let us know any questions, comments down below. Like always, consider subscribing, hit that thumbs up button if you got something out of this video. That's all we ask. If not, let us know what you didn't like in the comments down below. Thanks so much. Peace.